Hey everyone, welcome back to Broke to Better, where we turn complicated money topics into simple, relatable steps to grow wealth. Today, we are talking about something that can literally change your financial futures without spending hours picking individual stocks. Yes, the magical thing is called ETFs, which are exchange traded funds. If you are wondering which should I buy, what if I pick a loser stock, or I don't have time to do the research, well, congratulations, ETFs were invented for people just like you. Let's start off by thinking about what is an ETF. Think of an ETF like a basket full of different investments. Instead of buying into companies like Tesla, Apple, or Google, just one company. ETF is let you buy hundreds or thousands of companies in a single click. You are instantly diversified, with the meaning is your money isn't relying on just one company's mood. Imagine you're carrying groceries, one bag rips off, everything falls. That's like holding one stock, like one single stock. Now imagine holding 10 bags holding the same groceries. One rip, no problem. The others will have you covered. That's the power of having ETFs. So most of the people actually do get confused. What's the difference between an ETF versus a mutual fund? Well, people do confuse these two a lot. Mutual fund mutual funds are more expensive fees because they're managed by different companies, and they trade at the end of the day. They require minimum investment, but they are managed by the people. ETFs, on the other hand, they are usually cheaper. They trade like stocks, which is instant. They have no minimum payments, and they are often automated. So ETFs are like your smartphones, and mutual funds are like your old school flip phones. They both work, but one is clearly more efficient. One of the other things that in ETFs is why are they so powerful? Because they have a lot of benefits. First is instant diversification. You buy one ETF and suddenly you own stocks into a tech sector, a healthcare sector, energy sector, consumer goods, financial companies, and boom, crash protection already built in. If one goes down, the other will catch up. One of the other benefits is having lower risk because one company can go bankrupt overnight, but an entire index rarely does. The other benefit is lower fees. ETFs are famous for their extremely low expense ratio. That means more of your money stays working for you. The last benefit, which I think is it's easy to buy. Just open up any brokerage which you have in mind. It could be Robinhood, Public. There's so many out there with Fidelity, Schwab's, Vanguard, and just pick up a symbol with an ETF and you're done. It's that easy. The other topic that in ETF people do ask is what are the popular ETFs and what they do. Let's break down some of my favorites. To start off, it's VOO, which is Vanguard S&P 500 ETF. That owns the top 500 US companies. Historically, returns are almost 7 to 10% per year on average. The second one that I have is VTI, which is the total US stock market. They own, again by Vanguard, but they own every investable US company. You get exposure to small, mid, and large cap companies. The other one is QQQ, which is a tech growth ETF. It focused on innovation companies, which are Apple, Microsoft, Nvidia, Tesla, Amazon. The higher growth, a little more risk, but there are a lot of high returns on these. The SCHD, which is a dividend ETF, is for people who really want to have a dividends coming out of their ETFs, some passive income, some stability. So this is the ETF people really brag at barbecues. One of the other questions are the sector, because some of the ETFs actually cover different kind of sectors. So maybe you want to actually target specific themes. So one is iBuy, which is IBU. It's an e-commerce and it just specifically is for the e-commerce companies. The other one is IYR. It covers the real estate markets. XLE is energy sectors, and IHI is for any medical devices. These are good if you believe in the future of a specific industry. The other thing is ETF international because, well, it's a US market, but can I get more? Can I diversify? Yes, you can diversify globally. One of the ETFs is VXUS. It covers all international market outside of US. The other one is EEM. It's an emerging market. So in countries like India, Brazil, China, these are the countries they actually put their money in. Why? Because different countries boom at different times. So you can avoid having all your financial eggs in just America only. The other thing is how ETFs help beginners. Well, most people lose money because first they panic sell, because that does happen, especially if there's some kind of small market correction or anything related to that. The other one, they buy at the hype, they sell at the fear, and they always try to chase trends because there's so many financial gurus out there who can tell you here and there, buy this stock, buy that stock. So ETFs remove all of those emotional drama. They're like investing on a cruise control. You are driving and you have to rely your car is the one who's actually picking up the pedal. They are like, you don't need to first do a deep research because you are buying a bunch of companies. It's company analysis because most of the things ETFs are controlled by big hedge funds like Vanguard, Fidelity. It's a constant chart. You don't need to actually do a constant chart watching. You don't need anything. You just buy consistently and just chill out. The other thing is like, how do you start investing, or do you buy an ETF? Well, here's a very simple plan. You just open up a brokerage account, which could be any in the platform that is very popular. One of the one that I use is Robinhood and Fidelity, but a lot of people are very comfortable with any kind of user-friendly platforms. Vanguard, Schwab's, TD Ameritrade, there's so many of them. And just choose an ETF or two, which could be VOO, QQQ for growth, SCHD for dividends, VTI if you want everything. And the last step would be just buy every paycheck. This is called dollar cost averaging. It smooths out market volatility. And do not sell unless you need it for retirement or emergencies. And that's how you build wealth. One of the examples of the portfolio, here's an example for beginners. If you have 100% of your paycheck, let's say $100 of your paycheck, and from your paycheck you want to invest in, I will put $50 of it in VOO, which captures in the S&P 500. 20% I would put $20 I will put in QQ, which is the tech growth ETF. Another 20% would be VXUS, which covers the international segment, and 10% would be SCHD because it's specifically focused on the dividends. With all of this, you own global companies, tech innovations, dividend incomes, and the entire US economy, all while sleeping peacefully at night. At the end, I would like to share that ETFs are the cheat code for regular people who use this to grow their wealth without gambling. If you find this very helpful, like this video, comment ETF, and follow for more Broke to Better tips. And remember, you don't have to be rich to get started, but you must get started to become rich. See you in the next one.